Hello, everybody. Elizabeth Selasky here again. And thank you guys for joining me again on this journey, this adventure, whatever you want to call it. I'm so thrilled for you guys to be here. And today we are going to be talking about what you can expect in your monthly mortgage payment. Yes, you're going to be making one payment a month, but there's things that are included in there that I think we should talk about and show you exactly what that means. And so when I was making this video, I was looking for a sample mortgage statement. And I knew that the government had kind of put together something. So I was looking for it. And honestly, I didn't think it was very good. I didn't think it did a good job of really accurately displaying what you can expect. I was kind of surprised by this. And so one of the things that it included was a prepayment penalty, which, listen, most of you are not getting into a prepayment penalty. Probably 99.9% of you watching this video are not going to get into a prepayment penalty, especially for your first loan. It also didn't include mortgage insurance, which is something I think needs to be addressed because a lot of us are going to be paying mortgage insurance, especially on that first house if you don't have the 20%. We're going to talk about that a little bit more. So let's kind of get started and explain what is all included in this monthly payment. So we call it PITI, so principal, interest, taxes, and insurances. I also included in this MI or mortgage insurance. Again, we'll talk about each and every one of these further in the video. Let's get into the nuts and bolts, which is the principal and interest. This is where you're gaining equity. This is what makes this better than paying rent because you are gaining equity each and every month as portion of the principal and interest. So this is the part of your loan that will always remain the same. It will never change. So if you have a 30-year fixed mortgage, it will remain, the principal and interest will remain the same from payment 1 to payment 360. So that is important to keep in mind. This is the fixed portion of a 30-year fixed loan. Now the other sections, your taxes and your insurances, those are going to change. They're not going to remain fixed for 30 years. So you're going to you owe the city, you owe the parish, or I'm sorry, counties for those of you not from Louisiana, whatever state taxes you owe, whatever tax you owe for owning property, wherever you live, that portion is most likely not going to remain the same for 30 years. I haven't really ever seen that. So it's something that you need to consider when they come and reevaluate the property value that could change. Here they do it generally every 7 years, but it can vary wherever you are. So the value of your property according to the state or the city is going to change, and that will then make your payment change a little bit. So that there's a little flexibility in there. Insurance is kind of the same. It is not guaranteed to be the exact same every year. Insurance will change. It depends on if you had a weather event. So here in New Orleans, we are suffering from several hurricanes that we've experienced in the past, and our insurance is rather high. But hopefully we start getting new insurance providers and we'll be able to see some reprieve. And I want to start right here, right now, by telling everybody, no matter where you live, to every year check with your insurance agent to make sure that you're getting the best deal. Because you might have new insurance providers coming in. It is always important and key to shop your insurance each and every year because it can change. So as you can see, the taxes and the insurances are not set in stone. Those might change, and it depends on where you live and how often they might change. So I just want you to make sure that you will have a full understanding that although it's a 30-year fixed, that whole final lump sum payment will not remain the exact same. Only the principal and interest will remain the same. So now on to mortgage insurance. This is, again, what's going to be required if you do not put 20% down when you buy your house. It is not necessarily going to be on there for the life of the loan. Now, certain loans do require mortgage insurance for the life of the loan, but in most cases, we'll probably be looking at refinancing you out of those loans into a conventional loan where the mortgage insurance will naturally fall off once you've naturally hit 20% or 22% equity in the property. You might be able to get it to fall off a little sooner if you've done improvements or your area has increased. But initially, you're going to have that payment will include mortgage insurance. And again, we're going to spend a whole video on mortgage insurance and what you can expect there. But ultimately, this kind of wraps up what you're going to expect to see in that mortgage payment each and every month. And remember, the only portion of that is fixed is your principal and interest. That will never change. Your taxes and insurance will change, and eventually your mortgage insurance will most likely fall off. So I hope this was helpful, and I'm looking forward to sharing more information with you guys. And have a wonderful, wonderful day. See you later.